Welcome to the Whitwam Wealth Real Estate Podcast. And today our topic is single-family investing options.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Number two that I want to talk about is fix and flip. So we talked about buy and hold. Let's talk about fix and flip. So fix and flip is a little bit different than buy and hold because you're not going to keep the property long term. When you go to acquire the property, you're going to use a different methodology for identifying the property, for determining the rates of returns, determining what it is that you need out of a property. It's much different than if you're doing a buy and hold property because you're not looking at long-term investment. You're looking at buying this property, if it needs repairs, making all of those repairs, and then when you get done with the repairs, you're going to put the property on the market for sale. You're going to flip it. At least that's what we call it. You don't actually flip the house, but you sell the house quickly. So you buy it, repairs, sell it. And sometimes you can buy these houses, get a discount on them. They don't need much work. You can get them on the market really quick. We buy a lot of houses that need full remodels. And in fact, there's a lot of times we'll buy hoarder homes, and we've got to completely liquidate all the stuff that's inside of it. We've had houses that have taken over 15 dumpster loads to get them completely emptied, get the yards emptied, get everything cleaned out of it, and then go in, fully gut the house, and then start the remodel, and then flip the property. So let's talk about some of the pros and cons in the fix and flip area or fix and flip market. One of the pros, so here let's go over 5 pros. One of the pros is a potential large profits. One of the things about doing fix and flips is there's a potential for unlimited upside because it's going to be the market that determines your upside or what your after repaired value is. And there have been times in appreciating markets where we have bought a property that we thought was a very fair offer. We went over all the numbers with the seller. It was a huge job. It needed to be completely emptied out. Again, this is the hoarder home type property. And we unload the whole thing. We get it all cleaned up. And we strip the entire house. This one that I'm just thinking off the top of my head because it wasn't too long ago. All the ceilings, all the wall. We just de-sheetrocked it. We built some new rooms. And in the process of time, while we're doing this, the market's appreciating. It's going up at a rather rapid rate. So by the time we got ready to have this on the market, there was a large profit at the end of it. Now, we had purchased it with the intention of making a very good profit on this property, but there was a very large profit at the end of it because there is large profit potential on fix and flips. And so that is one of the pros. The other pro, number 2, that I would talk about here with pros for fix and flip is the potential of quick returns on your money because you can acquire properties that need very little work. Maybe you guys have to replace carpet and paint. You can have it done in a week, and the property's on the market, and you can quickly turn your cash over quickly. You might have a 30-day closing because you have a retail buyer coming and using a loan, but it's very quick return on your money compared to a buy and hold, which is much longer term investment project. So quicker returns on fix and flip than what you're going to have in the buy and hold market. Number 3 is control. When you're doing a fix and flip, you have a lot more control over the project than you do with some other systems because you're the one that's controlling the creativity within the project. You're determining the colors, the type of carpet, tile, luxury vinyl plank. You're determining the cabinets, whether they're going to be shaker, whether they're going to be recessed, whether they're going to have slow closed doors, whether there's going to be pullouts, and all of these other things. All the creativity belongs to you. Whether you're going to do very high end. So am I going to, do granite countertops that cost, $20,000, or am I going to do granite countertops that cost $5,000? You control all of the creativity and then also the budget. Right? So you determine whether or not I'm going to spend $10,000 just doing a light remodel on this thing, or whether we're going to gut this thing and spend $150,000 doing the remodel and make it high end so that we meet this this market that we are going after. So you're completely with fix and flip. You are completely in control of your budget. And I would say that this is probably one of the areas where people make their biggest mistake is in this area of budget. Is a lot of times they don't match their budget to their market. So that'd be the kind of the third thing under this area of control that I would talk about is understanding the market type and level. So for instance, let's say that you buy in a high-end area of town, and you go in thinking you're going to go to Home Depot and buy the supplies in order to fix this up and use, particle board cabinets and laminate countertops and that kind of thing. You're going to find that buyers coming to buy this property are going to go, no way, we're not interested in that. I mean, we're buying up here in this high-end area. Everything up here is much more expensive. We expect granite, quartz, marble. We expect solid wood cabinets. We expect slow closes. We expect, elevated toilets. We expect all of these things. So you want to, in the control, you have that in the fix and flip. You can match the product to the market. The fourth thing in this area would be active income. Fix and flip is an active income opportunity. So what does it mean, active income? It means that you're generating money over and over and over and over again. Where buy and hold, you're waiting over a long period of time. In the fix and flip market, it's active. So I'm going to buy the property, I'm going to rehab the property, and then I'm going to sell the property. And we try to shoot for 90-day windows on our properties. So if we can turn that money over, 3 to 4 times a year, that's really good. We love it when we get one that only needs carpet and paint, and we can, maybe get an additional turn out of that money. But it's active income. It's money that we use over and over again actively. It's not passive income that we're generating over a long period of time. The fifth positive is flexibility. With fix and flip, it can be very flexible for you. You can determine whether or not you want to buy in the low-end part of town, whether you want to buy in the high-end part of town, whether you want to do high-end renovations or low-end renovations, whether you want to make your renovations that would fit for an investor type quality product so you can sell this off to a buy and hold investor, or whether you want to make this for a final homeowner. So there's a lot of flexibility. You can determine whether you're going to add bedrooms, whether you're going to do an addition and add exterior space. We have one where we went in and it didn't really have a master closet. It had a good master bedroom, but didn't have a master closet. So we just added exterior space. A little bit more complicated because you got to get permits and those kind of things, but it gives you the flexibility to do those kind of things when you're working in the fix and flip and market. So now let's talk about what some of the cons or the drawbacks of doing fix and flip are. Okay, number one would be risk. Risk in doing a fix and flip. What if you buy the property and there are a lot more repairs than what you thought there would be? So that's a big risk, right? We call those cost overruns. What about if you buy a property and there's some I guess external features you didn't know. You bought a property, you didn't do a survey, and you've got lot line disputes. So all these things can add up into risk. Cost overruns is a big one. People buy a fix and flip, and they don't realize that when they bought the fix and flip that it was going to cost X. They thought it was going to cost Y, and now they're putting an extra $30,000 or $40,000. Even when you watch some of the shows on HGTV, they're going through and doing the remodel, and they find a rotted beam in the basement that's supporting the floor, and they can't do this addition because of it. You can run into those type of cost overruns. Sometimes with permits, you got a fix and flip that you're going to do an addition on. You go to get the permits, and then the city comes in and makes you do $15,000, $20,000 worth of stuff that you had not planned on doing. So it's easy to run into cost overruns. It is a risk, but the more you do this, and the more you kind of protect those things when you're getting into doing this, you can kind of limit those cost overruns. The other one is the inability to liquidate. What if the market changes? What if all of a sudden you go from 30 days on market in a certain market space, and now all of a sudden the days on market are 120, and you're having the inability to liquidate this, and because you've done repairs, you're at the top end of the market, and the lower end properties are selling, and yours is not. And so this is one of the reasons why you need to understand your markets. You need to gauge the repairs you're doing and analyze your risk. But it is a risk, the inability to liquidate a property after you've sold. There's nothing like having hard money at 18% or 14% or even 12% or 10% and having to carry that property for a year with those kind of interests, because that just blows your budget up. The third thing I would say in, kind of that area in risk would be, loss. What happens if somebody gets in and does damage? What if somebody steals things? What if there's a fire? What are those type of things? So there's the potential for loss, and that would be another thing under cost overruns, where you can run into a potential loss when you're doing a fix and flip. And sometimes it happens. I have not had very many fix and flips over the years that we've lost money, but there's been a few that it's just like, hey, just cut this thing, get rid of it. Let's take the loss. Let's take our money and put it into something else. So that's another one. Number 2 would be capital contribution. On the fix and flip side, you got to watch your capital contribution, because it's really easy. If you go the traditional route, you can get into a 20% scenario where you're putting 20% down, and then you're going, wow, or 25% down, you're going, wow, most of my cash is gone. How am I going to do the rehab? How am I going to do to finish this project? How am I going to finish the flip on this? So cash flow contributions can be larger on the fix and flip side. So the amount of capital that we have to invest when we're doing a fix and flip can become a con, especially like if you're going to do a big one. And we've had some of them where, you have to have $150,000 in some means. It doesn't all have to be cash. It can be your credit cards, Home Depot, Lowe's, supplier credit, whatever it is you're using. But the capital contribution can be a drawback when you're fix and flip. The other thing is time and effort. Time and effort can be a real issue for fix and flip, especially if you're just starting out and you're planning on doing some of the work yourself. The amount of time that it takes, the amount of effort that it takes you coordinating the help and the subcontractors and those type of things. So time and effort can become a real issue. If you're not experienced, you're probably going to have to hire more of the work done, and you're subject then to your subcontractors' time frames. You're not able to control it. If you're trying to do all the work yourself, it can take a long time and be very taxing. You're doing it after work because you're not doing this full time yet. That can be an issue. Most of us guys who are doing it full time, we don't spend all of our time in doing our own remodels, but we still have to manage our subcontractors. We still have to manage bids. We have to make sure that effort's getting put in on the job so that it can continue to move it forward. So time and effort is another con in the fix and flip. The other thing is market changes. You may be fix and flipping. Let's just say you fix and flip in Las Vegas, and the market changes in Las Vegas, but now it's good in El Paso, Texas. You have to understand market changes and determine whether or not you're willing to go where the markets are for doing your fix and flip investing. Sometimes you can just continue to take into consideration the market changes. Maybe you have to work on a little lower profit margin for a while because your market has changed, or figure out a way to do some things a little bit different. Maybe not only has the market changed with regards to price and the costs of doing the work, but maybe prices have changed. Maybe there's a real shift in prices and people are expecting a much higher end remodel than you're used to doing. And then you need to maybe adjust to those market changes to meet your clientele so that you're offering products that won't sit on the market and linger a long time, that you can get your properties sold. The fifth drawback with fix and flip is capital gains tax. And in this case, most fix and flips are subject to what they call short-term capital gains tax. So they're not taxed at your ordinary income rate. And you can talk to your accountant, your CPA, about how this affects you. But capital gains tax can be a real thing. If you have a short-term capital gain of, we'll say, $200,000, you may end up finding yourself writing a $30,000 or $40,000 check. Thought you did really great on this thing and write a $30,000 or $40,000 check to make a tax deposit because your accountant says, hey, you've got to put that money in there, and we need to make sure that we're covered when it comes tax time. So you want to make sure that that you're doing that also, because there's nothing like getting to the next year, finding out that you should have made a capital gains tax deposit and you didn't. And now not only do you have a capital gains tax to deal with, but now you have a late deposit penalty. So capital gains can be a little bit of a drawback. You've been listening to the Whitwam Wealth Real Estate Podcast, and I hope you have enjoyed this episode. I want to thank you for taking time to listening. And if you found this episode of real estate, single-family residence options interesting and helpful, please subscribe, leave us a review. And if you have any questions, please let us know. We'd love to hear from you. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.